Please welcome the panel on Private Markets, Keeping Up with Moving Targets, moderated by Chief Investment Officer of the Texas Municipal Retirement System, Yup S. Kim.
All right, good afternoon and welcome. We have a lot to cover today, so why don't we kick off with quick introductions and one icebreaker question. What is one thing about you that most people don't know? So Anne, if you could kick us off.
Thank you. Hey everyone, Anne Valentine Andrews. I run global private markets for Manulife. We're a top 10 life co, $1 trillion under management, and about $120 billion in private markets across all asset classes. Based in New York. Very happy to be here at Milken for the first time. What don't people know about me? Well, I'm 6 foot tall, and I have 4 children, and I have a 13-year-old as my youngest, and I'm officially the shortest in the house.
Wow.
Which was a momentous occasion, and I knew I was going to be the shortest, just not now.
Amazing.
Okay, Bennett Goodman. I'm the executive chairman of Hunter Point Capital. We are a capital solutions provider to the GP world. With regard to what you don't know about me, I'd say I now like to go to bed before 9 p.m.
Me too.
Good afternoon. My name's Andrew Milgram, managing partner and chief investment officer of Marblegate Asset Management. We're a distressed debt and special opportunities credit manager. I guess the one thing that people don't know about me is that during college I was a lumberjack.
Oh, wow.
Wow, impressive.
Yeah. If you got any trees, you need to.
Good afternoon, everyone. I'm Michael Rees. I'm a co-president of Blue Owl, the private markets firm, public private markets firm, and I'm the founder of the GP Stakes business, formerly known as Dial, within that business, and focus on running that effort. I guess I would say my secret skill is that I could rap every single word to Run DMC's Tougher Than Leather album.
Hello, everyone. Matt Wesley. I run the private capital group at Jefferies. That's the primary placement agent business. It's all of our private equity secondaries business, as well as our GP Stakes advisor business. So it's about 100 professionals around the world. The thing that people don't know about me, and I think we're going to be able to team up on this, is I'm a great break dancer. At least used to be.
Yeah.
Haven't tried again soon.
We can sort of put on a little performance after.
That's right.
Get a little linoleum floor going, and you can...
Invite only.
Good stuff. All right. And we'll start with you. So private markets has undoubtedly entered a slower era. But unlike the great financial crisis, institutional investors remain deeply committed to the private markets asset classes. Why is this the case? And what are the long-term structural advantages that private markets has over public markets?
Yeah, so we're going to talk crystal ball stuff here.
Yes.
Which is always fascinating. And, Elon inspired me a little bit yesterday talking about learning history and thinking back. So if I think back just about 15 years in private markets, everyone was doing private equity, real estate was big, infrastructure was not interesting to anyone because it was too low returning. Credit was just starting to bloom after the global financial crisis. And, no one was really talking about ESG, right? Or it was a weird green impact thing. So you just think about where we've come in 15 years. It's pretty incredible, right? So lots of the big asset managers are now listed. They're interested in gathering assets and, looking across diverse businesses. We're decarbonizing the world. And look, I just think the structural forces that are behind us now are going to stay, right? So again, I can't predict how much it's going to grow, but being able to do things in the private market, being able to control, being able to have board seats, being able to do things in a very a very sort of patient way, I think is what is needed as governments are strained and we need to, rebuild the world. So I think that's why people are still going, and I think it's going to continue.
Great. Thank you, Anne. Bennett, over to you.
Yeah, I would say that the efficacy of private market strategies and investing has stood the test of time now for over 25 years. And essentially, you could earn 300 to 500 basis points above the public benchmark equivalents. And the structure that kind of drives that is private equity has proven to be quite effective at operating intervention to improve a business, thereby creating enterprise value. You couple that with the advantages of the economic incentives of private ownership, and you have a highly motivated management team, an aligned shareholder, and you're doing all of this outside the glare of quarterly financial reporting.
Great.
So I too think it's going to stay for quite a while.
Awesome. And before the next question, just wanted to poll the audience. So private market share of global equity market cap has doubled kind of in the past decade. Raise your hands if you think private markets share of global equity market cap continues to take share in the next 10 years. All right, we have a bunch of private markets bulls in the room, which is good. All right.
They self-selected.
Michael, America has lost about half its public companies since the 1990s. And against this backdrop, global private markets AUM has compounded at a 14% CAGR for the past 10 years. Does this secular megatrend continue indefinitely? And what are some of the near-term obstacles that might cripple kind of private market share gains?
Well, I think it's first good to put into perspective that while the market share has doubled, it's still a very small fraction of the total global wealth. When you look at the market having grown from about a $3 trillion private market in 2009 to about $13 trillion today, you think that's fantastic growth, but it only represents about 5% of global wealth allocated to this space. And you think it's a pretty big market after all this growth, and you think about all 6,000 private markets firms, it's only a tiny bit bigger than the market cap of the Magnificent Seven. So you have to really put it into perspective of it's been an amazing growth trajectory, but it still is relatively small as a share of wallet of global wealth. But we think it continues. We think there are a number of new client segments that will really take up the slack in increasing allocations. A lot has been talked about this week about insurance, private wealth, sovereign wealth, geographies like Australia and Japan. You look at just those areas alone, and we easily see the industry doubling from 13 trillion to 26 in the next 5 or 6 years. So it certainly, there are structural tailwinds. What could derail it? A lot could, but it'll likely be idiosyncratic headwinds than something more macro. If there's always sort of the threat of fraud or regulation or something that ultimately will sort of pause the long-term structural growth. But I think, as Bennett mentioned, just the structural outperformance caused by the drivers he mentioned and just the right asset liability matching that private markets typically affords, it just likely will continue to drive us towards the up and to the right on the growth trend. So haven't seen anything yet that worries us about the overall macro trend in private markets, but we'll keep an eye out.
Great. Andrew?
Well, look, historically speaking, financial innovation in unregulated spaces has not been given over to self-restraint. And so ultimately, I think what will define, the mix of public versus private will be the regulatory environment in which we operate. And, today, markets are benefiting from the sort of happy bedfellows of leverage and optimism. But, should something go wrong, should something break, I wonder if that will continue to be a happy marriage. And I think it probably will invite regulatory scrutiny in probably a more profound way than this room anticipates, probably this entire conference anticipates. And what I would say is that when regulators act as a consequence of something breaking, they don't tend to act with restraint. Regulators, when acting, tend to overact. And so I would just say that I think we are today enjoying a benign regulatory environment that may persist. It may not.
We have to thank the crypto markets for taking the attention of the SEC away from us and other asset classes.
All right, Matt, next one's for you. It's everyone is witnessing the large firms getting larger as LPs over-index to cycle-tested, marquee brand name firms in the marketplace. And while 2023 had successful mega raises across the board, it masks kind of a gloomier reality that, basically year on year, there was a dramatic 40% decline in the number of funds closed. And so it really seems that there is a bifurcation of mid-market specialists and the mega cap players who are really dominating kind of the market share in recent times. So how does that play out kind of in the next 5 years?
I do think that we're entering a time where there will be a bit of a tale of the haves and the have-nots. I think in the next 5 years, you're going to see a larger percentage of middle market firms who have not raised a fund that's equal to the size of the last fund that they had raised, maybe even a subsequent vintage beyond that. And LPs certainly are looking for, in the middle market and the lower middle market, specialization of those sponsors, right? How do you differentiate yourselves relative to all of the other options on the menu for you? The one promise I would say, and to inject some optimism into it, is we have a global sales distribution force that's calling on LPs around the world every single day. And if you see those call notes today and compare them to call notes from 6 to 9, 12 months ago, there certainly is more optimism. You see LPs who are saying, not only do we have allocation to be able to fill all of our re-ups, but we have a slot or two, maybe even 2 to 4, depending on the region they sit. Whereas a year ago, they were having trouble even hitting the right re-up. So I do think that there is reason for optimism, but certainly, there will be firms who just don't get to even 50% of their prior funds raised. I do think that will be something that emerges.
Yep. Bennett?
Yeah, I would say fundraising, whether you're a middle market firm, a big cap firm, it's just harder.
Yeah.
And LPs are just much more discerning today, and that's a good thing. I think too many mediocre managers were able to attract capital over a long period of time. And those firms that have distinctive competence that can create the flywheel of activity that every great firm needs. There are 3 vital signs in our judgment. One is you got to continue to sell companies and sell them at attractive multiples to invested capital. Call that, 2, 2.5, 3 times, depending upon the strategy. 2, you got to keep deploying capital. And you're going to need to not only deploy capital, but invest in transactions in those sectors where you have expertise and dominance and competitive advantage, but create co-investments for your LPs. Which leads to the 3rd vital sign. You got to be constantly expanding your investor base.
Yep.
And that co-investment activity helps drive that. Very few LPs in the world like being the first person to commit to a fund. Many prefer being the second or third. So the art of all that is to try to create some momentum by showing you have other investors interested. But if you can deploy capital, if you can monetize your deals and create DPI, distributions paid in, and you can create co-investments for your LPs, which has become a much more important component to a successful firm's outlook, you then create that flywheel. And whether you're a middle market firm that does it or a big cap firm that does it, you're going to be able to raise more capital. And there are plenty of examples of big cap firms that haven't done it, and they're having a harder time. And we all know there are lots of mid-market firms that haven't done it, and they're having a harder time.
There's a lot of big cap firms that are starting to rewrite their co-investment strategy or to establish it for the first time altogether because they see how important that is. And to take Bennett's points one step further, not just DPI and co-investment, but a lot of LPs around the world are now saying where else in the capital structure can we invest, right? Can we, not only do we want to see co-investment opportunity, we want to have opportunities to invest in the credit of the underlying portfolio companies.
Yeah, absolutely. And as LPs like myself want multiple touch points with more scale kind of platform relationships, you've really seen kind of a GP consolidation, kind of emerge. And also GPs are now really investing to build capabilities across the entire private markets, spectrum. And the approach at which they do this is, twofold, right? Some will do it through inorganic kind of acquisitions, through M&A, and others will do it more organically through organic platform expansion. So I'm just kind of curious, in your view, what are some of the pros and cons, with each approach, and what would you comment on just this mega trend in general?
Yeah, so it's definitely a mega trend, and it's going to definitely continue, right? Picking up on a number of the points we've just talked about, LPs are requesting more. There's more compliance, there's more back office, there's more tax, there's more regulations, and if you're a small manager, particularly if you're having issues raising capital, a lot of those managers are looking to find larger homes. And what are they looking for in those homes? Right? They're looking for distribution capability. They're looking for often seed. They're looking for a manager that can take them in and then also help them seed and grow their products, and also looking for folks that can help them grow their talent base. So the sad news is there's no silver bullet. Growth is hard, however you do it. I like to say that, as a leader of a large platform, you have to look to do both organic and inorganic. There's no silver bullet. So, organic is hard because you've got to hire people, bring them on, and make sure they're the right culture and that they're doing investments the way that you like them to do it. And you've got to obviously raise capital. First-time funds are hard, as we just talked about, although it's easier if you've got an existing platform and you're just going a little bit further away from a strategy that you're doing. But it's slower, right? Like getting that up off the ground, it can be slower, it can take more time. So on the inorganic side, there's a number of benefits if you can find the right match, if you can find that right cultural team. Obviously, if there's performance issues, that's tricky, right? So you've got to find the right mix of culture. I like to always say, folks need to be a little bit institutionalized. And, it helps if they're used to doing that, because obviously if they've been working as a boutique for years, there's a lot of culture clash if they come into a big organization. So you've got to find the right match of culture, the right point in their career that they're still looking for heft to grow, that seeding I talked about. And then also you've got to find, obviously, the right price. Doing a deal is easy. Actually making it work and having it happen to, 1 + 1 make 3 over a 3, 4, 5 year period, that's where the hard work comes in. So, I think there's going to be much more manager consolidation that goes on, particularly as folks can't raise as much capital as they want and their ambitions are larger than what they can do. But it's famous that a lot of acquisitions have not been successful.
Yep.
So I think that marriage of cultures and that vision is incredibly important to make it work.
Michael?
Well, just on a sheer numerical basis, the industry has a very low level of inorganic growth. The amount of M&A that happens is basically zero compared to the stock of the entire industry, and it's for all the reasons that were said. I mean, you can see, particularly from a few of the public companies, a need to fill in voids, and they had no choice but to acquire a platform. Typically, it's someone who's more equity-oriented, trying to grow into the credit space by buying somebody. But ultimately, this consolidation, we think, will be driven just by sheer market share gains by the top 200 firms, compared with the 5,800 or so that they say exist, that will, more or less sort of wither and begin to atrophy. Doesn't mean they'll all go away, but I don't see a reason why this industry, as it matures into its 5th decade, will need 6,000 different firms. And so I think that sort of just continued consolidation at the top and organic market share gains by the biggest, strongest firms, I think that's what will really be the driver. And it's because the fact that the marginal dollar, the marginal investor dollar is harder to get. It's not in the 50 state capitals where you could cover it with 1 to 2 salespeople. And that's how this industry grew for the first 3 decades, was to cover endowments, foundations, and 50 state capitals. And that didn't require scale and heft and headcount and a whole new way of marketing. And when you transition and add to your repertoire the insurance segment and the wealth segment, you need to build an entirely different business model. And that's what I think we're seeing. And that can only really be funded at the top sort of 200, 300-ish firms in the industry, and why this journey from 13 trillion to 26 will largely be consolidated within those top firms.
Thanks, Michael. Andrew, when I talk to senior private equity deal makers, the greatest concern that they have is really justifying the equity returns relative to what credit investors get to enjoy, much more senior in the cap stack. How do you think about kind of the relative risk reward across the different private market capital structures today?
Yeah, I mean, I think the important emphasis is today.
Yep.
There's an old saying in credit markets that nobody pays 12% for long. So it goes one way or another. So I don't expect this to last for infinite period. I think there'll be a correction one way or another. Something will give. Either credit spreads will tighten, I guess, even further. Inflation will disappear, and rates will go back down to 2%, and equity will enjoy, I guess, the marks they have. Equity will suffer the consequences of the shift in value between equity and debt. Middle market companies in particular, which are the primary breeding ground of this high coupon debt, they simply can't absorb it. Most of them did their probably original leverage transactions at 6%. Facing the prospect of paying 10% today is not doable. And so that means that at some point, either, like I said, we have to have a change in the rate regime, or there will be some meaningful swapping, substitution of debt for equity, where there'll be a handover of control.
Sure.
But that seems inevitable in meaningful scale.
Matt?
Tough to follow that. Look, I think that there is a game of chicken being played right now between owners of assets and potential buyers of assets. There's $3.2 trillion of NAV in the U.S. held in alternatives. About 40% of that has been owned for over 4 years. That's 4 times the amount of value that was held pre-global financial crisis. So there's a big wave of value that needs to trade hands in one form or another. You could take some comfort in the fact that there's also the largest amount of dry powder also sitting on the sidelines. That there's never been. It'd be nice if I also had that number memorized, but I don't. But there's going to have to be some kind of acquiescence, right? There's going to have to be a place in which folks meet in the middle. You can't have a fund that you raised a year ago, 18 months ago, and have only put 1 or 2 new platform investments into that fund. And so while there is going to be a re-rating, someone I heard the other day said, is there really price discovery in our market today? There probably is the lowest amount of price discovery that there's been, not just in the private markets, but in the public markets as well. But there is a factor that's going to push values to stay at least at some level that I think the doomsday scenario, I don't think comes true.
Well, I don't know if about a doomsday or not, but I do know that, I keep hearing, oh, there's infinite amounts of private credit, there's infinite amounts of private equity, and yet nothing seems to transact. And so, this chasm between buyers and sellers, goes straight to the heart of valuation and where people have things marked, what they're trying to achieve, what they've told their investors to expect. And look, unfortunately, when you go through periods of this level of illiquidity, particularly in private markets where there's a lack of transactions, generally speaking, it hasn't resulted in a happy ending. I think in general, that resolves to the side of the buyer, the person who's willing to provide the liquidity. I think that we are in a particularly acute moment, and I think that we face a difficult political environment. We face a difficult interest rate environment. Stimulus is wearing off in the economy. McDonald's, of all people, is telling you that the consumer is starting to weaken. Credit card delinquencies are up, auto delinquencies are up. The story is not a bright one. And so if I was to, say that somebody's going to cross the bid-ask, my guess is it's the seller.
And then we are talking about private markets sort of as one big collective or PE, but there are parts of the private markets that are very active at the moment, given the structural tailwinds. The infrastructure market is obviously active and still lots of transactions happening, just given the, again, as I mentioned, the need to decarbonize the world and build, the new universe. So infrastructure is still very active, and I think a lot of investors had not filled their allocations. So that and real estate, obviously, I know we have other panels on that, but real estate's obviously going through a fundamental change at the moment, where office is, kind of frozen, and people are working out discovery. There have been some keys handed back, but then other areas are actually still quite liquid and happening. So, I mean, we talk about this as one big collective, but there are different parts of the market that are still very active.
Absolutely.
No one really ever gets credit for being the one that says, it's rosy out there, everything's fine, et cetera. So I have no idea why I'm going to try this. But, we reported earnings.
We're just sitting next to the debt guys.
Yeah, no, just slightly more positive. But, we at Blue Owl reported earnings last Thursday. We've had, since the launch of our credit business, have had about 6 basis points of realized loan losses. Our earnings growth of our underlying portfolio companies is anywhere sort of high single digits year on year. They're everything, Andrew, you said, we sort of agree with, but we just haven't seen any of it yet. And maybe we'll be sitting here, if we're fortunate enough to be invited back to speak next year, and talking about calamity, or maybe we'll be talking about the fact that the economy and the soft landing actually worked. I look around, I see sort of 6, 7, 8 of our GPs in the audience, and 201, they're going through big exit processes above mark. We've looked at every manager, every exit they've had for the last decade or two, and 95% of them have been above mark. I don't know what the next cohort for the next 2 years will be, and that might be the reckoning moment. But right now we don't see anything yet coming through in our credit business. Mike Arrighetti was on this morning right outside, said exactly the same thing. So there probably are pockets, but just generally the large buyout market seems to not have begun to show any signs of cracks yet.
Well, let me take that on just a little bit. So, I mean, I think what Fitch has told us is that 82% of private credit is originated to single B- or lower. Now, we have 50 years of S&P data that shows that triple C's default at a 3-year cumulative default rate of about 30%. 50 years of data shows that single B- defaults at something like a 20% 3-year cumulative default rate. So, it's definitely true that a lot of private credit managers are not showing high defaults. But if you don't call a default, you don't have one. And so I view that as a little bit of a false dawn, a little bit of a manipulated statistic. I would ask how many waivers are in a portfolio, how many amendments are in a portfolio, what is underlying performance in the portfolio. Look, it's possible that this time is different. It's possible that 50 years of data is wrong. It's possible that everyone's a genius or not. Look, you're right, time will tell. The evidence over time is that the current environment will not persist. The evidence over time suggests that there will be a reckoning, and there will be winners and there will be losers. Jamie Dimon said a couple of weeks ago, and I agree with it, you know, there are a lot of super bright people doing this, just not all of them.
Yep. Bennett, you're in the business of both underwriting and advising the operating business plans of many private market platforms. Have you seen any fundamental shifts in kind of the longer-term priorities of many of these platforms as they look to scale, you know, both vertically through AUM growth and horizontally through product extensions? And just another crystal ball question, but you know, is the business model of private equity going to change in the next 10 years, or will it look very much the same in your view?
Well, I think that the model has evolved over time, and you know, we might not appreciate all the changes, but you know, if you went back, you know, 10 years ago, you know, it wasn't really private equity; it was leveraged buyouts.
Yep.
And you know, all these firms bought mature businesses and got the most leverage they could possibly get, and they kind of rode that game.
Yeah.
Well, that you know, that led to people innovating, trying to, you know, if you can't get your cost of debt below what KKR can do or what Blackstone can do, you know, how do you win business? Well, you got to be really good at running businesses differently and thinking about how to bring in operating talent to change the business model. You know, think about how do we grow, and that was kind of the change, or actually the evolution from LBOs to private equity. I think that will continue for obvious reasons. To me, the big change that's on the periphery, you see it at some firms, it hasn't fully matriculated to everyone, is the use of technology, particularly artificial intelligence. There are many people who now have data scientists on their payroll, and actually making, you know, substantial investments in these kinds of endeavors. And they have these broad portfolios covering large swaths of the economy. They all feed data, customer data, spending data. And what they're trying to do is to use algorithms to create predictive power that enable them to make better investment decisions. And I don't think anyone's cracked the code. But I do think that is going to be the next evolution in private equity as firms try to figure that one out. And you know, that will be profound.
Yep. Matt?
The AI thing is interesting that, you know, a lot of our business is on the secondary side, and the secondary market is split between both big, large, diversified LP portfolio trades and then more concentrated GP-led continuation fund transactions. And the LP side, it's really, you know, looking at a distribution curve, the quartile of a sponsor, a vintage year, where DPI is today, and there's a few people starting to use AI in a very real way to replace large portions of investment teams to be able to very accurately price that risk, price those portfolios. We're helping a new emerging sponsor raise one of those funds right now, and it's pretty interesting. You can have a investment team that's about a quarter of the size. So when you think about profitability of a sponsor for folks like Michael and Bennett, that's certainly something to consider. On the evolution just of the asset class in what is an otherwise illiquid asset, the continuation fund product has become significantly more used, utilized, and adopted than ever has been before. From our numbers in 2019, exits to continuation funds as a percentage of total sponsor exit volume was 5%. You fast forward to 23, and that jumps to 12%. So that's largely a function of a shrinking denominator rather than a growing numerator. But the numerator, exits to continuation funds, are only down 24% off of their peak in 21 versus an M&A market that's down 60%, an IPO market that's down 80%. And so that kind of fourth exit lane has really proved to be a pretty resilient one for private equity sponsors, particularly those in the middle market. And LPs are largely supporting that strategy. In 23, there was $90 billion of dry powder raised by secondary funds. That's more than the $70 billion that was raised between 21 and 22 combined. And so we do see LPs, particularly these concentrated single company continuation funds, really start to be reclassified as a new asset class, or at least a accepted, twin brother, twin sister of co-investment, right? A lot of LPs are now saying, even though there are fees and carries associated with it, we will go invest in that asset class. And that's providing, I think, one additional out for sponsors, at the marks, at or around the marks of where those businesses are held today.
Yep. Yeah, absolutely. And Magnificent Seven profits collectively now exceed that of most countries in the world. And their collective equity market cap has really risen dramatically from 1.4 trillion to almost 14 trillion today. It used to be the case that private markets held a near monopoly on the equity value being created in the global innovation community and the economy across biotech, consumer tech, enterprise tech, deep tech, and the like. It seems like the track record is a bit more mixed now, right? As we all can appreciate that VC and growth equity investors have been incredibly negatively impacted by rate rises. I'm just kind of curious, in your view, is private markets still the best way to access the innovation economy?
Yeah, and I was just going to make another point just on, on the evolution again, and just picking up on the sort of 15 years back, 15 years forward. Mainly the vehicles were these, big open-ended vehicles, and thinking about all of the innovation that's just come in terms of structures, right? Open-ended vehicles, non-listed REITs, separate accounts. I mean, there's just a lot of different ways people can access private markets now. And also moving into the high net worth democratization, which we touched on in terms of needing big sales forces. I mean, the normal man in the street wasn't able to get into these private market deals. And that, I think, is a really big change, right? That hasn't gone through a whole cycle yet. Obviously, everybody's not doing it yet, but being able to invest in these deals, which you previously couldn't get access to, again, 15 years ago, no one was doing this. So I just think this is a massive move. Look, I think in terms of getting access to VC and earlier stage investments, I do think private markets, still works. I mean, maybe not really on the pointy end, VC. I think that some of that's R&D labs and companies doing that. But I do think that there is an appetite. At least we've seen an appetite. Again, going back to the decarbonization lens, for being able to invest into technologies that are then going to move along the risk-return cycle, kind of move from growth to then infrastructure and then all the way to PE. And I think people like understanding what's coming down the pipe and understanding these technologies, right? We've all gone back, I can certainly speak to myself, a little bit more to science lab, right? Understanding how things work, how you decarbonize, how are we going to do this, right? It's fascinating. So I do think people there is appetite for it out there. Obviously, true VC has been hit, but we do need to invest in these decarbonization technologies. And so there is appetite out there, right? There is appetite, we're still seeing it.
Michael, thoughts?
Well, I think obviously the venture growth world will still be the major platform off of which the innovation economy will be built. I just think as a prediction, the pig and the python in venture growth is going to take way longer to sort itself out than anyone's thinking right now. I really, the market, that market sort of cracked after the first quarter of 22. We're 2 full years in it, and literally nothing has happened. It has been a complete stalemate. No new investment in the sort of later stage growth or late stage venture, early stage growth. It's just been completely frozen. That's when a lot of people talk about the challenges in the market, where the headwinds are. It's a pretty narrow band of what private markets represents, but it can be, a pretty meaningful calamity for a investor's portfolio, because that 7 quarters that preceded it in midway through 20 through that first quarter of 22 that was the largest allocation to venture and growth for 7 straight quarters, and it made venture growth a larger industry than the buyout segment, which is the first time ever. So that is really the root cause of what you hear from a negative perspective. It's that excess allocation to a small number of firms in count, probably 100 firms, that really has not moved. No new investment, no new monetization. And until investors start seeing that return of capital back, the numerator effect will stay out of whack, and we'll have a slower allocation pace than we've seen in a while. So I just think for us to see how that pig works its way through the python and sorts itself out, we don't see any signs of it. And people were saying, oh, but just give it one more quarter. We're not talking quarters. I think it takes years for that side of the market to really sort itself out.
Andrew, next one's for you. We've seen a spike in base rates from about 525 basis points from Q1 2022 to Q2 2023, the sharpest we've ever seen in recent decades. How is this macro environment informing kind of your go-forward strategy? Just curious, how's it impacting your existing investments, but also, how are you kind of thinking about offense here?
Yeah, look, I think this, the macro environment today is very much a K-shape economy. So large companies, public market access, pricing power, own the end consumer are doing quite well. Middle market companies who are suffering the pressure from the large companies, because middle market companies tend to service large companies. They're also taking the pressure of wage inflation, oil prices, other commodity and factor inputs. So they're really getting squeezed in the middle. And we just published a white paper in the fall. We're updating it with some new data now that shows, looking at about 1,200 private companies who are not in the broadly syndicated market, whose financials are not easily accessed, looking at a huge array across the U.S. economy, and what you see is horrific. The EBITDA is down, greater than 30%. Margins are collapsing. Interest coverage is now on average just at 1 times, with a full quarter of those companies well below 1 times interest coverage. And so again, I hate to play to type to be the distressed guy on the panel, but the reality of the data is clear. In the middle market, and by the way, we see it in the consumer. There's a 2-speed economy, the haves and the have-nots. That's true in amongst corporate borrowers as well. The bottom is crumbling, and just because we don't have great transparency to it doesn't mean it's not happening. Look, I think that ultimately those chickens come home to roost. Ultimately, that will be reflected in transaction values. Ultimately, that will redound to investor returns and the returns available to allocators.
Yep, absolutely. Bennett, as Matt alluded to earlier, about a quarter of the $1.2 trillion of dry powder out there in private equity land is 4 years and older, creating kind of a heavy incentives for GPs to get off the sidelines and transact, even if conditions aren't ideal. Just kind of the passive approach of waiting for conditions to recover doesn't seem to be a long-term viable strategy. Just curious, in your view, what are kind of the implications for deal making? I think there's a lot of folks who do think, some of the seller capitulation will begin to occur the latter half of this year and things, but Just curious how you kind of think about this situation.
Yeah, I just think fundamentally you have people that control and own assets who don't have to sell.
Right.
And you have all that dry powder on the sideline that just can't make the math work to get to a 20% return if they're going to have to pay 14 times cash flow and pay 10, 11, 12% for senior debt. So what I think ultimately has to give to break that logjam is a combination of spreads tightening, which we are beginning to see.
Yep.
Spreads on unitranche debt have kind of come in 25, 50 basis points. We certainly see high-yield bond spreads come in even more. But we do need base rates to come down.
Yep.
And I think the conventional wisdom is 6 to 9 months from now. Conventional wisdom, by the way, is never right. But at some point, if rates kind of come down, that will be what primes the pump for deal making.
Yep.
Because the fundamental economics just don't work. And people that have good assets and aren't required to sell have no motivation to cash out.
Bennett, do you think that they will, like, that decline in rates will be contemporaneous with a thriving economy?
No, I actually think it's the opposite.
Yeah.
That what will cause rates to come down is the labor market cooling off, employment going up. On the other hand, I think most long-term investors will look through this recalibration that you know, I totally agree, you're right. But I don't think people view it as catastrophic. I don't think many people would take a perspective that there's this huge bubble in private debt.
Yep.
I happen to think recoveries will be lower, defaults will be higher, but I think it's an adjustment to valuation. We don't have like a banking crisis on our hands. The U.S. consumer who drives all of this is still in pretty good shape. If unemployment, goes from, 4% to 5%, 5.5%, we'll get through all that. So I think longer-term investors are going to, yes, anticipate a decline in the economic outlook. That's a function of recalibrating your underwriting assumptions, how you put together your projections, what you think GDP growth will be, and what could your company that you're about to buy do relative to GDP. So I think that what will embolden the private equity buyer with all of Matt's dry powder will be this notion of rates coming down, their cost of capital coming in, and they're going to rationalize putting the capital to work.
Yep, all makes sense. And just to switch topics a little bit, what lessons have you learned about leading during times of uncertainty and crisis, as we're kind of seeing now, right? So just curious as to if you could share with the audience just some nuggets of wisdom of really leading through times of uncertainty.
What I think is really interesting is that a lot of the young folks in the organization haven't lived through a lot of this uncertainty, right? If you think you've only started work recently, maybe you lived through COVID, maybe you liked working from home, you haven't really lived in this uncertain outlook, right? So I guess what I've learned and what I've learned from looking at leaders that I admire is over communication, like being very, very clear in terms of this is what's happening, this is why it's happening, and really just sharing a lot of information with folks, right? And particularly matching up investors with older investors, younger investors with older investors, and explaining how different crises unfolded. I think a lot of the folks who've worked in our markets haven't lived through, have had this long, great moderation of interest rates, so they haven't lived through times like this, whereas a lot of us have seen, different crises. So my approach is always over communication and, making sure people are teaming up and talking with each other and, just sharing lots of views and being very open.
Great. All right, we have about 10 minutes left, and so wanted to go through kind of a fun lightning round questions for the audience. And so we'll kind of keep it light initially. So every answer less than 15 seconds, please. So we'll go. All right, favorite hobby, Anne?
Photography.
Golf.
Golf.
Not golf.
My kids.
Awesome.
That's a hobby.
It's that or work. Sleep.
I like that one.
All right, Matt, we'll start with you this time. Favorite birthday meal?
Oh, pizza.
Pizza.
Fajitas.
It isn't everyone's teppanyaki.
Any kind of Italian food.
I'm going to say home-cooked Sunday roast.
Nice. And if you were not a private markets titan, what would you have been in life?
That's a hard one. I think I would have stayed probably a lawyer. I trained as a lawyer originally. I'd probably be a lawyer.
I'm a civil engineer by academic training, so I probably would be designing bridges.
Cool.
Very cool.
Power forward for the New York Knicks.
Well, I'm a mechanical engineer by academic training, and I was really good at pump design, which clearly had no application in today's world. They can design.
But Michael, I think we could get a partnership going.
We probably could do something, build like a bridge with a
Pump.
spray water off of it.
A hydro
Disney
facility. You
World,
could build a hydro facility.
A break dancer. No, I thought you were going to say rapper. I was also a lawyer in a former life, so I'd probably still be a lawyer.
Oh, great. All right. What is the greatest life advice and career advice you've received in your life?
Life advice is that you're as good as the best, but no better than the rest. And the career advice, I think, is, it's a marathon, it's not a sprint. Have confidence in yourself that you're going to get to the spot you need to be in.
I think my answer to both questions is the same, and it's a little cliched, but humility is, the sort of the most free thing that you're given that you can easily play out into your life and your work life. And I think people don't take the opportunity to seize a free asset. And so as we sort of look back at what it takes to be a partner with some of the biggest, most successful firms out there, you could sort it, rank it, and do whatever you want to it. But I think the core is being humble and having a high dose of humility in everything you do.
Great.
I'll have a couple. My grandfather once told me, know what you know and know what you don't know. And the second I heard relatively recently, which is, if it's not hell yes, it's no.
Like that. Who said that, you know?
Yeah, a good buddy of mine.
The most influential person in my life was my uncle, who happens to be a legendary baseball coach, who built a dynasty at LSU, Louisiana State University. And when asked, what is the key to success? He said it's all about the 3 H's: hard work, honesty, and humility. And I've tried to lead my life that way. And the way I lead my life is the way I do my business. So the 3 H's.
Yep.
I like that. I subscribe to, life is 10% what happens to you and 90% how you react to it. And I find that one's very helpful in terms of just living your life. And the other one in our family, we have a family motto, which is just keep swimming, from Nemo. And, when it's a bad day, just keep swimming.
Right.
All right, Dan. What is the single biggest mistake a private markets investor can make today?
I'd say. It's the single biggest mistake I think you always make, by the way, which is overpaying for an asset, particularly in this environment.
Yep.
So I'll say that.
I think the biggest mistake usually comes from your successful investments, where you think you're a genius and you think you know more than everybody else. And what happens is hubris sets in. And I think that's the Achilles heel to most investors.
Yeah, I would say something similar, over-reliance on pattern recognition.
Yeah.
You have to approach every problem as a white sheet of paper.
Going fourth is hard. Fifth is even harder.
Trying to get my third answer.
Yeah, exactly. You know, the private markets, it wasn't discussed in the first 55 minutes, but you know, at the core, it is a people business. And you know, when you realize that you're going to have to work through good times, bad times with pretty much every investment you make, you have to sort of think through, is this the person you want with you for this journey? I've been quoted as saying this, and everyone always comes up to me after and asks which three, but we have 66 partners, and I would say 63 of them are great, you know, great groups led by great people that I feel, you know, are the type of human capital you want to work with. And I guess if you want to ask me later who the other three are, I still won't say it, but give you a few hints. But yeah, pick good people to work with, to partner with.
Agree with complacency. Agree with something you said before. Know what you don't know. Something, you know, an event you just can't foresee. But there's another side of the coin, which is, you know, if you have conviction, also be able to trust your gut and lean in. And you know, having been on the buy side in 2013, 14, 15, you know, the folks would sit back and say we could have bought so much more, we could have deployed so much more in 2010 to 2012 if we had a real, you know, conviction in it. And so don't be afraid of conviction. Don't be afraid to lean in if you truly feel like you have a good opportunity.
Yeah.
Yep, we have 3 minutes on this shot clock in front of us.
Yes.
Well, we're doing all the talking, but you sit in an amazing position where you see, you know, GPs come through your office all the time. You talk to your team about asset allocation, where to go. Can you give us some words of wisdom to close on here? We should have all been listening to you.
No, I mean, obviously as moderator, all the insight lies here. And so, yeah, I mean, again, I'll kind of stick to the script this time.
Oh, come on, here's
but we can chat offline. If you could give yourself a phone call to your 21-year-old self as you were starting your careers, what would you share?
I'd say everything's going to work out okay.
Yeah.
Don't be afraid of the struggle. Enjoy the struggle.
Yeah.
Enjoy what it's like to feel uncomfortable. Lean into that uncomfort. Have confidence in yourself that you know, you have the tools to navigate that.
Yep.
Spend more time with family. Probably.
Yeah, invest more in human capital, invest more in relationships, you know, build that muscle as much as the technical muscle that Wall Street tends to overemphasize.
Yep.
I would say try to pick a firm, if you're coming out of college at age 21, where you look around and you can find mentors. Because I think where you start your career doesn't matter that much. It's helpful to be at a good firm as opposed to a bad firm, don't get me wrong. But far more important to have someone that you admire, someone whose values you can respect, someone that you would say, I want to be like that when I grow up. And have that person vested in your success. That's a real powerful dynamic for a young person. And you know, I know I was certainly quite fortunate to have had people that played that role in my career, and I think that's what really created a lot more opportunity for me down the road.
I was going to say something similar. Pick people, not brands. I think when you're young, you're looking at sort of shiny brands and shiny things versus who you're actually working for and what they're teaching you. And that's certainly advice. But you just said something similar. So I'll go with a Back to the Future moment, which is buy Amazon and Apple when they leave.
But not Bitcoin. All right, last question. For what in life are you most grateful?
My health and my family.
I am blessed to have a remarkable family led by my wife, who is actually sitting back on the aisle over there, who will certainly be critiquing my performance this afternoon when we're done.
Oh, you just got a lot of brownie points. Yeah. Good shape. Don't worry about that.
I'm super lucky to have a wonderful family, a great business partner, and a business that we've built to be proud of.
Kudos. I'd echo that. Obviously, the family, thankfulness for a family goes first and foremost, but having a group that you come to work with every day and they feel like your family and it doesn't feel like work, that's a true gift, and I'm blessed to have that as well.
I think families, why we're all up here.
Yeah. Yeah, fifth is always a little hard. All right, well, thank you so much for joining us today, and round of applause for the panelists.
We hope you enjoyed the discussion. Please make your way to your next session.